What's the fallout from rising conflict and oil prices? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Michael Gayad, portfolio manager of the Free Markets ETF and publisher of the Lead Lag Report, and Weston Nakamura, founder of Across the Spread Research and Substack. Hi, gentlemen. It's great to see you both.
Good evening, Maggie. Good evening, Michael.
Good morning, Maggie. Good morning, Weston.
And this is going to be a fantastic conversation because, of course, Weston is joining us from Asia and Michael is here as U.S. markets open. And I'm really grateful to be able to sit down with both of you today. As we speak, investors are digesting news of a massive Israeli airstrike on Iran's nuclear facilities. Iran has retaliated. There are concerns this could widen. Oil jumped over 8%. Global stocks are under pressure. Let's just start with sort of top of mind reaction from both of you. Michael, what are your thoughts?
I mean, we've seen these back and forth, attacks last year, or I think or even a year and a half ago, and the market reaction initially was, panic, and then seemingly nobody ever kind of cared about it afterwards. So the attention span of a flea is what's going on with most beta investors. This one may be more serious because it seems to be much more of a prolonged campaign by Israel, and given that the starting point on oil futures was like near record shorts, you can see how and why you'd have this 8% move. You just need anything to kind of cause a short covering rally. So part of the magnitude of the move may just be because of that and things kind of settle down. The initial reaction actually does not look too aggressive to me in terms of the flight to safety behavior you otherwise would see. Gold is up, but it's not like it's spiking. Treasuries as a flight to safety asset aren't, the yields are actually looks like they're rising as we're chatting. So I think it's still too early to tell if this is going to be a bigger issue. To me, as Weston knows very well, this remains sort of a catalyst potential for Japan, which may really be the thing that is the thing to focus and worry on the most.
Yeah. And we're going to dig into that. Weston, your thoughts, because
Yep.
again, you were sort of in a market that was happening in real time,
Open.
I suppose.
Yeah.
Open.
That was
Exactly.
during Asia hours. So that massive spike in WTI crude just crude oil futures. It does seem. I mean, look. Obviously, it's not fundamentally based because at the time of this recording, this seems like very early innings, as in Israel is saying they're not even done yet with this like first round of attacks. So it's not like we're waiting on Iran. We're waiting on Israel to finish doing what they're doing and then waiting on it. So there's so many variables. So that initial headline hit spike, that's clearly, an algo triggered move. And then there was a lot of calls to options positioning for this because this was kind of flagged towards the end of last week as a potential, and so those I guess went into the money. And basically, I mean, I have no idea if this has anything to do with anything, but Japan AM cash close hours are at 11:30 a.m. and then they reopen at 12:30 p.m. Between that hour, that's when crude did its it spiked, and then it did a massive spike, and then came right back down right at PM open. And the Japan listed Simplex WTI crude ETF, this is like the most heavily traded crude ETF, basically didn't catch that move. That ETF is up 8-9% on the day, but so I don't know if that has anything to do with anything, because they obviously within that ETF are futures, but yeah, it's just pre-positioning from those who got the call right, the geopolitical trade, but that's that one trade only, and from here on out, who in the hell knows what's positioned for what.
Yeah.
So, yeah.
One of the things I was thinking about this morning, and obviously, it goes without saying, we're going to talk about the market function. It goes without saying that there are, this is distressing to so many people on so many levels, both from a human perspective and a political perspective. One of the things that I was thinking about when trying to figure out the market reaction is this is happening, as you said, telegraphed. But when you have a geopolitical event like that, you have a geopolitical event on top of a very volatile U.S. administration. So it's hard to game these things out ever, which is why the market tends to kind of have a swift reaction and then ignore it. but it's especially hard now because you've got so many confluent things happening, and volatility and uncertainty in all of it. I mean, if people were talking to me about like even 4 months out, 5 months out being just a fog of uncertainty, I can't imagine that this makes it, this makes it even more, I think, difficult to navigate. So we arranged to talk, the three of us, because you've both been talking about, and I've been talking with you about, this risk of Japan. I'm sitting here in the US, and I can assure you that most of the conversation on traditional media today is going to be about, what does Trump say? How does the US respond? What does Trump say to this? What are the relationships? But you're both watching other parts of the market that don't get as much airtime and don't get as much focus, and that is particularly Japan. And this oil setup, Michael, is one of the things that you spoke to me about as being a potential match that could sort of ignite a situation that you find really worrying. Can you walk us through this, and Weston, you as well, because you're putting out a report just today saying Japan is perhaps the most dangerous market.
GGBs.
Yeah. So let's, Michael, start with me with oil, and then Weston, will have you fill in as well.
So the whole reverse carry trade thesis is relatively simple. It's not really about the yen. It's about oil, because Japan imports all of its oil, and oil is denominated in dollars. So that means oil priced in yen has all kinds of other interesting implications in terms of cost push, inflationary pressure on the country. So I've used that line repeatedly in a very annoying way on X, at Lead Lag Report, by the way, self-promotion, that Japan will panic. And what I'm referring to there is the idea that if you were to have an oil spike and the yen is weak, then really oil priced in yen is a lot stronger than what you're seeing in dollars, which is a problem for a country that relies entirely on importing oil. And the panic part means that since Japan cannot control the price of oil, they can control the price of their currency, that they would do whatever it takes to make the currency itself appreciate to counter the price rise in oil, or at least slow it down. And you do that with either raising rates or selling treasuries to buy currencies, raising dollars effectively. This, I think, still remains sort of the big risk. I'd argue it's also what's kind of pushed out the reverse carry trade thesis a bit, because oil has been weak for some time.
Mm-hmm.
But if oil were to continue to push higher, then I think you're going to see the yen start to strengthen, because that's going to be Japan effectively paving the way for cheaper oil price in yen, which has all kinds of implications on leverage.
And Weston, talk to me about how sustained would it have to be? What's the situation of the BOJ? Presumably, they understand the implications of that as well. How are you thinking about that calculus?
So, right. So I just put out like a major piece of work, video and written, and basically the title being that the JGB market, Japanese government bonds, are the most dangerous market in the world, which is not hyperbole. I gave specific examples of, like, not examples, definitions of, and checklists of what makes the market dangerous and why this fits, and all of that kind of thing. And so what I'm looking at basically are long end yields, bond yields. Long end Treasury yields are being driven by long end JGB yields. And that seems to be a singular focus, the long end of the U.S. Treasury curve and all that kind of thing. So from that perspective, when I see oil spike 10% intraday off of this, and assume, let's just say that it just sustains, right? Higher energy prices, as Michael has been correctly saying. Yes, oil is priced in U.S. dollars. Higher U.S. dollars and higher oil prices is a bad combination. One of those, even just one of those, is a bad combination for Japan. Japan already has is subsidizing like energy, household energy costs and all that. There's a July upper house election coming in Japan as well, and like all candidates are basically just doing the voter bribe of like fiscal stimulus for this and that. And that. I'm not saying that it's justified or not. I'm just saying like this is what they're doing.
They're spending, they're promising fiscal in order to get votes, like every politician
right.
everywhere.
Yeah, like it was coming, in the form of like stimulus checks at one point to combat Trump tariffs and all that. To the other opposition party, main opposition party right now is talking about dropping consumption tax rates to 0%. Which means that you're once they go down there, then you're never going to be able to raise them up. But that funds Social Security. So what the hell are you going to do? So basically, what that means, all this means, is more JGB issuance, more flooding supply of pieces of JGB papers, into the world, and an absence of buyers because the Bank of Japan is tapering. And so when I see oil spike even more, like at the very least, I'm going to assume that that's going to be more issuance of JGBs, and that's going to be even more higher yields at the long end for JGB yields, and therefore higher U.S. Treasury yields at the 30-year long end as well.
Make,
So
make
that's
that
kind of
make
the
that
lens that I'm looking
connection
at.
though, Michael. Why is more, because these are markets not every, certainly people watching, because we have a super smart community, will be following along with this, but other people will be like, what do you mean? Like, why would higher JGB yields immediately result in higher Treasury yields?
Well, first of all, there's the economic principle of the law of one price. Similar assets should be priced similarly, right? Doesn't matter where in the world it is. But the mechanics of it are, if JGB yields are rising, then probably the fiscal situation is worsening even at a faster pace for Japan. And then there might be a need to sell treasuries to help raise some liquidity because of that very reason. And that creates sort of this doom loop, you can argue, to some extent, right? And then you combine that with the currency reaction to that, because now they're also raising dollars as they're doing that, on that end. So, yeah, and by the way, as U.S. Treasury yields rise for reasons unrelated to Japan, that also worsens Japan's situation because they're holding it, right? So you can see how it becomes like a very sort of nasty cycle and self-fulfilling prophecy dynamic. Now, part of my thesis on the reverse carry trade was that yields would rise first, and then you get the flight to safety trade, where the idea that they crash stocks to save bonds comes into play, where then yields drop. So there's an initial spike, causes fear, then equities drop, risk on assets drop heavily, and that forces money back into bonds to kind of resolve that initial yield
U.S.
drop.
bonds.
Right, U.S. bonds, right, as sort of assuming they're still the pristine asset, which a lot of people don't seem to think is the case because of the horrendous nature of duration the last several years, but that's part of the thesis. So we'll see. Look, we've been through a number of these sort of glimpses of it potentially happening.
Yeah.
And then nothing. This could be that, or maybe this is the start of it. Who knows?
Yeah. Why are you so concerned? You look across all global markets. Why are you so concerned about a carry unwind? That would have to be people. What would spark? Like, walk me through, and because I think we're talking about currencies and bonds, and so it's clear in your minds, but it gets a little muddled. What would spark? Why is oil potentially the catalyst to spark a yen carry unwind? Or the carry trade unwind?
Well, it goes back to because Japan imports that oil. But on the point about the carry trade, it's like, I'll ask Weston this. For somebody that's in Japan, what do they think is safer in higher inflation, JGBs or Nvidia?
Like, the answer is Nvidia, and it's not... It's like not a joke.
Yeah, no,
you're genuinely asking me.
What's the importance of that question?
Because what ends up happening then, and Weston and I have talked about this before. And
it sounds ridiculous, I know.
Yeah, but it's true. Right, go ahead.
It is true. Like, because it sounds, the question itself sounds ridiculous for somebody who I guess wouldn't know. Like, you're asking, would you rather own like your country's sovereign bond,
which is supposed to say,
right. Yeah, with no currency risk, and not a country like some like a frontier nation, like like a G7 country, that also seems to be impervious to like debt dynamics, or like indebted dynamics, or like a 6,000 PE, heavily levered long holding equity, single stock. But the reason that they find safety in Nvidia is not because they find safety in Nvidia. It's because they're trying to the safety part of it is not the buying of Nvidia. The safety part of it is the fleeing of the melting down currency and those assets that are denominated in said currency. And so if that means Japan equities, or if it means cash, Japan cash, the yen, for until 2025, 3 years prior, for 3 years running, worst performing currency for 3 years running, like down double digits year after year after year. That's supposed to be like your savings, your mattress, your cash. You're like, because I don't want to invest because I don't want to lose money. That's why I'm holding cash. That's what that's there for. And now you are concentrated long the worst performing currency or one of the worst performing assets. And so it's doing performing the exact opposite function that it's supposed to. So what do? You get the hell out of it and you get into USD denominated assets. And as long as you're doing that, like you buy an asset that's going up seemingly, and those are Nasdaq stocks, not just Nvidia.
So is that still true? Given because the narrative is that the U.S. dollar is about to have a generational depreciation and a bear market, and that it's the end of U.S. exceptionalism, and that it's the rest of the world that you want to own. So is if you listen to people in that camp, it's the U.S. dollar that's going to be the worst performing currency, and U.S. equities and U.S. assets are entering a prolonged period of being out of favor with international investors. Do you not buy that?
So I'll narrative follows price, and path matters more than prediction. All those narratives could be true, but in between now and then, you could get some nasty tail events where the dollar spikes, right? And there's a flight to safety, and there's a reversal of that money that's fleeing Japan that got deployed into Nvidia, Nasdaq, Max 7, and by the way, probably levered into it because, hey, if your country's currency is worthless, you might as well borrow it and put it somewhere else. And that creates the tail event, right? It's the whole reason Japan is important is because it's a source of leverage for the entire world.
Yeah. So this is how I'll answer your question, Maggie. When people say like U.S. investors, Japanese investors, or what have you, there is no such thing as a monolith within like sub categories of investors, right? When you say like when I say you, I don't mean you specifically, Maggie.
Yeah.
When people talk about international investors, that is not a monolith. That is the most non-monolith thing ever.
You always say this about
the
dollar too. It's the pair, not the dollar.
Yeah, exactly.
Right. So what I'm saying is that it depends on many factors, but one of the key things is like, okay, where in the world are you from in which you are a non-US international investor? So if you're from like Europe or something like that, okay, so the euro had basically gotten crushed since 2022 when central banks globally, except for Japan, had started to rip their respective interest rates higher, and you saw this like rip in the dollar higher, and the euro USD cross, like basically just getting crushed and all that kind of thing. All of those, like that entire move had been just retraced and is gone basically, right? Like the Euro USD cross is basically flat from like 2022 like start. Okay, dollar yen is up. The yen had depreciated, some 20, 30, 40%, since then, and remains there still today. Okay, so if you're like a European or a Euro denominated investor, yeah, it's easy for you to like say things like you have the choice of like being in like Euro denominated assets or US denominated assets, or like, but if you're in Japan, you just still got fucking hammered, like like your purchasing power or exchange rate value has still been crushed, and so it does not make the whatever's like happening with the US, it does not make your home currency more attractive still. Like it's still a better option. It's still a better currency or a way to preserve your melting ice. There's and the correct, I think, but the overall sort of sentiment is not one of let's repatriate back to yen. Like let's continue to hold yen. Let's add more like yen exposure to our already extremely overweight long cash positions or like cash holding allocations. No, it's like we need to take advantage of moments of yen strength. And by the way, dollar yen 144, I can't believe that's considered yen strength, but like because not too long ago it was in like close to parity of like 100ish, a little bit above, but they're using those to kind of literally dollar cost average in, and buy U.S. Dollars, or it's not buying U.S. dollars, it's buying, or it's fleeing of the yen, right? So it, like, all whatever happens with tariffs and this and that, it doesn't make people here at least hate the yen less.
I think
So
this is why global perspective is really important, because I think that you're right. It's easy to sort of, generalize too much. So, Michael, there is this feeling that even though this has been building for a long time, right? But Japan always muddles through, like and I know we talk about risks because you need to be prepared for them. But like, is there a feeling that they can just continue to muddle through, or is it your sense that they're kind of running out of runway in terms of that, even though it's been decades?
Yeah. I mean, look, we know that policymakers are very creative at preventing creative destruction, which is the muddle through argument. They find some way to kick the can down the road until the can eventually kicks back. But there is an endpoint to that where it doesn't work anymore, right? And we're seeing incredible moves on the long end of the Japanese bond market.
Yeah, all-time high recently, right?
And it's like, and seemingly people are like, oh, it doesn't matter. Yeah, well, it doesn't matter until it matters, and then when it matters, it's the only thing that matters. I mean, it's always how it works, right? So it's like, you don't get into an accident most of the time when you're driving when it's pouring outside. You can probably be fine going at the speed limit or even above it, and then guess what? The one time suddenly happens out of nowhere, right? So to your point, the challenge with this is that it's actually very hard to manage, because the way it plays out, the path, the sequence, the when, that's the big question mark. So how do asset allocators position for that? In some ways, it just means you have to already be positioned, which in turn likely means a portfolio having things that could benefit from a tail event or volatility. It's going to lag of pure risk on portfolio. And guess what? If you're managing money for other people, that's hard to sell.
Yeah, and that's the problem. We're going to get in terms of how to manage and how to position and what you should be thinking about. Weston, is the Japanese government losing control of the JGB market?
Yeah. That's what I was going to add. So like the whole premise of my piece of saying that the JGB market is the world's most dangerous market. Like I said, this is really not hyperbole. And people who have followed me for even just a little bit know that I have been keeping close tabs on JGB markets for a very long time. I've never before characterized any market as such before. The reason I'm doing that now is because it has been a dangerous market. It's arguably one of the largest bubbles in financial market history, but that was carrying on just fine, I suppose. But now it is actually hitting this inflection point moment, because you have a fundamental shift in which the Bank of Japan, basically the Ministry of Finance in Japan is the most over indebted government in the entire country, in the entire world, 250% debt to GDP, and all that. But Japan is just carrying on just fine, because the Bank of Japan and Japan has the lowest interest rates among the G7, despite being the most indebted. Japan also is the largest foreign fixed income investor, which means that Japan is simultaneously the country that is the most indebted and lends the most at the same time. Okay, now, so what's been happening is that the Japanese government obviously does not have enough money to fund its expenditures and is not collecting enough in taxes and revenue. So they issue JGBs. Who buys JGBs? Like, the private sector does for a few moments, and then they flip it to the Bank of Japan, who now owns half of the outstanding debt. And so why can't that continue? What's wrong with that, right? So, actually, so there's now a limitation. There is actually a limitation to the Bank of Japan doing this funding of the government. And what that is market functionality. They basically, when you have this massive non-economic whale who steps into markets, who literally sets prices and lines in the sand of where the yields cannot trade higher than, and all that, ends up owning half the market, destroys liquidity, destroys any sort of pricing mechanism for corporate bonds, for corporate bond issuance. When you have ARBs, market makers, participants, normal market participants, leave and disappear and all that. And when you have completely changed what used to be a market into whatever the hell this trading sort of system is, and then you want to exit it or want to taper out of that in a severely destroyed market, the reason that they're doing this, the reason that the Bank of Japan is tapering is because they actually have hit a limitation. The limitation is that market functionality has been completely like busted up, such that they can't even effectuate their easing anymore. So they have to continue to not buy, or to buy less and less of the long end of the JGB market. Even if yields are breaking through all-time record highs, they're more, they're just limited by, like, they can't buy, they don't want to own one more long dated JGB than they have to. And what they're finding out is that in their absence, nobody is there. There's no demand for it.
Because they've
And so
destroyed the
now what
market.
you're seeing, right? So what you're seeing now is that the Ministry of Finance, that the body that issues JGBs, is now taking the reins and is doing the JGB long and yield management role. And they're doing that by kind of jawboning, like, oh, we're gonna, cut our, long end issuance to, like, our duration, like, we're gonna term it out to make it shorter duration and all that. This is just like, these are catalysts that are coming up later this month, for meetings and all that. But it's all just kind of like talk for now. But the most significant thing is that rate policy, long end rate policy in Japan, and therefore the rest of the world, because Japan is the global yield anchor, has now been shifted to the elected government side. So much for central bank independence. Not that was really a thing anyway, but the Bank of Japan has completely, like, it actually has hit a limit, and that's a first, right? And so you're likely going to just see continued yields. If JGB yields continue to hit record highs, then that's going to push up U.S. 30-year yields ever higher, just as they have been very highly correlated since April, May, and that's going to create a ton of problems. And then you're going to also have potentially pockets of illiquidity where you have, like, sudden jumps of 20 basis points intraday in both JGB long end yields and U.S. Treasury long end yields and German boons and UK yields and so on and so forth. So
Michael,
that's the difference.
That's a great explanation, Weston. Does the market, does the U.S. government know that that the Japanese government and the JGB market is so critical and basically, like, determining the U.S. bond market?
Oh, I'm sure. I mean, how could they not? But whether they can do anything about it, I don't know.
That's really my question. That's really my question. Like, do they operate under the idea that yes, it's going to affect it, but we still control it? Is the U.S. government and Fed at risk of losing control of the U.S. bond market?
I could answer. So, like, if in my so I just put out a video about this whole thing that I was just talking about, and in it I have a clip of Scott Bessent from recently, and he's being asked about. The question to him was, this is from Bloomberg, on an interview in Bloomberg. They asked him, Congress is not really standing up and applauding this big, beautiful bill. Are the markets wrong? And then Scott Bessent very correctly says, this is not bond markets reacting to acts of Congress or anything U.S. derived, for that matter, because this is a global yield move higher, right? Yeah. And this is not Scott Bessent being the chief bond salesman, as they say, because the line after that he says is because maybe, and then he points to Japanese yields being higher and all that kind of thing. So he's basically saying U.S. yields are higher because JGB yields are higher, right? So you don't have to take my word for it. You can take it from the United States Treasury Secretary. But the reason I'm saying that that's not him being the bond salesman is because he follows that by saying maybe yields are higher because people think that, this bill is going to create growth. That is Bessent being the bond salesman.
Right.
Therefore, like things before.
Right.
So basically, if Scott Bessent is saying that, U.S. yields at the long end moving higher are not due to U.S. internal matters, and if he's also saying that the 10-year U.S. Treasury yield is basically the most important price that he follows and is kind of guiding his policy decisions almost, then what that effectively means in combination is that, as Michael just alluded to, Treasury Secretary Bessent is saying that the Treasury Department's policy is indirectly being guided by developments out of Japan and the JGB markets, is what that means.
It's political scapegoating.
Yeah.
Right. Yeah. It's like it's them, it's not us.
Yeah. So, Mike, when it's convenient, and then wait, it's them is a problem.
Yeah, of course.
What do investors do about this? How can you sort of? what would fallout look like, and is there a way to protect against this? Because you just said it's going to lag, right? So maybe they muddle along and we kick it down, but if you are worried about this and you want to sort of set yourself up for at least some protection or hedge against this, is there any way to do that?
First of all, I would have a marathon of Godzilla movies playing all day long, and just because learn about Godzilla and Mothra, and because that might be a way of getting to understand things. No, I look the I go back to, it's like, when did most people fix the roof? It's after it rained, right? So it's like you have to fix the roof before it rained. Okay, so all that means from a portfolio perspective is you got to be exposed to risk on assets that would behave, fine, because maybe they do kick it down the road. But you also have to have some exposure to things like gold, things that would benefit from that flight to safety trade, which I still think would be long duration treasuries in the latter part of
Right,
that
big spike
sequence.
first, but then
Yeah, exactly. And then
demand,
in my
bad
thesis, right,
recession, some
right,
terrible
maybe,
global
yeah,
economic.
maybe even having some oil, right, in case that is truly the catalyst, and having some exposure on the future side there, or with ETFs that play with the 1 month futures, or several months. So again, it's more about, like, if you're going to try to prepare for something that's a risk, you have to realize the risk there is you're going to lag, because it could take a while to play out. But otherwise, there's no point to having this conversation. I mean,
Right.
we're trying to bring attention to a condition. The condition is not a guarantee, right? The condition sets the probabilities, right? Maybe the probabilities are now more elevated. If they're more elevated, then you need to think more seriously about that true diversification.
Yeah. I think that someone, I don't know if it was you, Michael, or someone somewhere in one of our conversations, it came up that are we looking at a situation where in the US, this is specifically US, that US officials are going to have to make a decision to save the stock market or the bond market? Is this, if we have this fallout and yields start moving, is it
I,
does it
I
follow
don't
on
think
that whatever they do to save the bond market or get
Yeah,
control back of the bond
that's
market?
been sort of and more and more people have come around to that thesis, which I had really 2 years ago. I keep saying they'll crash stocks to save bonds. By the way, that's not me being dramatic. That's just historical fact. You look at the top biggest 1% declines in the S&P 500. Guess what, folks? Yields drop on those days. Like, that's the flight to safety, right? That's the saving the bonds. Now, the interesting thing about that, which is the other part that's missed on the argument, which is also pure fact data wise, when you look at those major declines in equities and you see yields dropping, it's the saving of the bonds, because there's that flight to safety bid into U.S. government debt, usually long duration. Even as the market then rebounds, yields tend to drift lower. Okay, this is what's missed by anybody that hears me saying that argument. When you actually look at the data, there's this persistence of yields continuing to drop as equities in that capitulation massive decline may have bottomed and then return higher. And that's where you can argue the bond market, in quotes, gets saved, while equities also get saved. But you have to have break equities first.
Which is a terrifying thought. And your
Yeah,
feeling is you
I,
have exposure to the long end, knowing that there's going to be short-term pain, but if your time horizon is right, that you'll benefit, that you'll be ahead of the trade.
Yeah, now it's always about sizing with this stuff, right? I mean, but that point about the drift lower in yield is actually the most important takeaway from the data when I actually look at it going back to 1961. Right, so that's the play. That's why I think you need to have that tail event. Anybody that thinks I'm a perma bear doesn't know what they're talking about. I'm arguing for a tail event that resets the way the trajectory of yields is currently, which is what the U.S. government wants to refinance this huge debt load.
Yeah. Weston, you were going to say something?
no, all I was going to say was just very simply that maybe this is way too simplistic of a take, but if like officials in the U.S. or otherwise, if they had to choose one, like to save like which asset class, stocks or or the government bonds, clearly their sovereign bond market matters way more, because I mean stock markets, yeah, they matter. They matter for, like, we all know why they matter, okay? But like, the people's 401ks, yeah. We're talking about, whether government, how and like in what way governments like can fund themselves, budget themselves. Where do those like funds go to, like allocations, all that kind of thing. All those, like, whether or not they can jump into a war with Iran or not. or
Yeah.
central
Or
bank
if you're
policy,
gonna, if
all
push
of that
comes
stuff,
to
and that
shove. Yeah.
it clear, yeah, and it's like the stock market is, it is a private sector sort of enterprise, like government hands off. The government bond markets are not really that at all. I mean, they
Yeah.
issue them, they
Yeah.
it is their sovereign instrument. So of course they have to save
Great
that
point. Ironically, it comes
over
at a
stock
time when the
markets.
U.S. government is talking about giving individuals, like on the lower end of the economy, like $1,000 to put in the stock market. So
Yeah, why not?
Yeah.
Why not?
perhaps an unfortunate
Can,
political time to maybe that will fall out of the big beautiful bill.
can I just
yeah, go ahead,
yeah. Oh, sorry. I just want to add to what Michael was saying, though. About like the drift lower in yields. I just want to add to, as long as we're kind of talking about that topic. So post Liberation Day, all you hear about is this like crazy phenomenon that everyone that we witnessed. Where like I'll never forget the day when I saw U.S. yields rising and then
Well,
the dollar dropping
you'll never forget the day.
simultaneously.
You'll
And oh
never
my
forget the day
goodness!
for
And
another
like,
reason. You'll never forget the day for another reason. Liberation Day.
well, that's different. No, but like, but that narrative that you constantly hear, like when yields went up, but the dollar went down, and that signaled this, like the foreigners were okay. So fine, maybe foreigners, maybe some of them were okay. But as I point out, do we not also remember that in the actual immediate aftermath of Liberation Day of April 2nd,
Right.
yields plunged,
Right. Thank you. That was
plummeted,
right.
and then they went higher. And by the way, they're not even at they're not like JGB yields, as you said, Maggie, 30 and 40-year yields are at all-time record highs. They're not even at year-to-date highs. They're kind of hovering around there. Okay, so like where's the fire, right? But like people only talk about this yield move higher. Yeah. If you don't include the fact that they plunged, and therefore that yield move higher is in context of that, it's a reversal of that plunging.
Right.
If you don't include that part, then you're I don't know if you're purposely or otherwise, but we're missing that context.
Well,
of
this
it.
is
So,
why I have you guys on, because people are the reporting around this is very surface. It's a headline. And
yeah, so let me add some, because this is particularly close to me because my 3 tactical funds, not the free markets ETF, rotate to Treasuries. And I had been noting that Treasuries are acting risk off, and to Weston's point, they unequivocally did. Yields dropped as volatility, which is classic flight to safety behavior, right? So you saw for a moment in time the return of that dynamic. And then to Weston's point, then it reversed. But Treasuries relative to equities did look like a classic risk off spread, okay, in terms of how much they outperform, but they did so with equities, the denominator really of that ratio dropping. Just a final point on this sort of stock market, what do they save? A stock market crash can cause a recession. A bond market crash causes revolution. You want a soundbite? You want a soundbite? That's your soundbite. Forces revolution. No, it's true, right? You can't have the system breaks like that. So of course they're going to say bonds, right? But and again, it's a mechanical dynamic. I'm not saying it to be dramatic. It is fact. You go back to 1961. Take the top, the worst performing days, worst performing weeks. Look at Treasury yields. Go to the CRSP data set on the 10-year Treasury index, which basically is like what an IEF or TLT would essentially track, total return, and see what happens to the return of Treasuries after those big declines. And what happens to equities come back and yields drop. It resets the cycle.
So let me ask you a question against, again, a popular, I think, narrative out there or thought. So we have this, it's always something that comes out, right? So we have right now, we'll see whether this is it, but we have a geopolitical tension, spiking oil, potential to light a match. We have Japan losing control of its bond market. We have the US under pressure, back up against the wall, potentially yields going higher. Maybe they'll be forced into some sort of action that's going to be negative for equities. When you're looking for safe havens, and I understand that argument from both of you, when you're looking for safe havens, what's to say this time the safe haven, the best opportunity is not in U.S. Treasuries, is not a dollar-denominated asset. It's fill in the blank. It's emerging markets.
It's fart. You want to say it's fart coin. It's okay.
or
I happen to think
Bitcoin,
but
or that.
Maggie, it depends on, again, it depends on from where's your starting point.
Yeah.
So again, like
Right.
if you're in Japan, the U.S. dollar is still a safe haven relative
Not
to your,
Europe, not emerging market basket, not an
or
alternative.
anything that's not JPY denominated asset.
anything it's not a
Right.
reserve
So,
currency.
but if you're asking like from the U.S. perspective, like a USD denominated U.S. Investor, is that like the framing of your question
Well,
of what a safe
I
haven
think
is?
it's
Or
not necessarily, but maybe, because what I have a parade of people on here saying is that in this kind of environment, facing these kinds of risks, which you both just outlined, I think wonderfully, because it's so interconnected, it's the end of hiding out in the US is over, and now it's the rest of the world. So pick maybe a basket of it, right? It's not one answer. Maybe it's Brazil, maybe it's Europeans, consumer giants, maybe it's China, and some Pan Asian holdings and Bitcoin. Maybe you have to have all of that and reduce your exposure to US, because that era is over. That's what I'm asking.
Yeah, no. So I would say the issue with that is that if that era is over, we have bigger things to worry about, because the implication is the U.S. dollar is no longer the reserve currency. I mean, let's go with that, right? And it's like, all right, well, if that's the implication, well then, okay, we might as well do what Jamie Dimon is saying and stock up on bullets. Like, no, really, it's like, dude's right.
I saw him say, yeah,
right? Maybe the dude's
saw
right.
him say that,
right? But this is my point. It's like you have to think through what are the implications of that when everyone spews that. It's like they're saying that, and then they have their money in a bank account. What, you think your FDIC insurance is going to matter to them?
Yeah. Okay, so so if you can only, it's like what's knowable. It's quantifying the knowable, and that scenario is just not a knowable, because the implications.
That's the end of the world. It goes back to the end of the world. It's the bull case.
Right.
It's like if everyone thinks that way, then it's going to be the exact. If that's the extreme and that's the end of the world, it's not going to happen.
Yeah.
That's why I keep saying the end of the world is. I keep using that line among all the other one-liners I use on X. That's that scenario.
Right.
Yeah. So my personal thought is basically that, like, again, it depends on where you're coming from and like what you're running from. What is your risk that you're like you're safe, that you're running in order to, what's the safe haven kind of destination that you're but the original risk that you're running from. And so that varies from person to person. So one person's safe haven might be another person's. One person's Nvidia might be another person's Nvidia for another purpose, right?
Yeah.
But I hate to sound like probably a regurgitation machine, but like fixed assets, like the golds and all that. I mean, like they get repeated often for a reason, right? Those are not gonna necessarily. I mean, history has
time tested.
Proven, yeah, time tested and all that.
Yeah.
And then I would also say that, like, I think there is way too much panic about the fiscal health of the United States and the investability of United States Treasury bonds.
Yeah.
I think that you're going to get your money back in full on time and your coupons in full and on time.
Of course, because they have a money printer. Of course, it's like I don't understand these arguments.
Yeah. Same with JGBs and all that kind of thing. And so I don't. And like, just as long as you hold the duration and all that kind of thing, and then
the argument
fine,
is
you might
be worth less. That's
right. And listen,
it might be worth less, but on an exchange rate basis, like if you're not going to see like the yen or the euro, then like GBP, like surging versus the dollar. They're like all fiat currencies will just be devalued, but like as
in tandem. By the way, there's a G7 meeting coming up. So not only do we have hot war.
You timed this real well, Maggie. You just nailed on the timing of this.
But I want to go back to but we do have to. I mean, people have so little faith in anything ever being worked out. We seem like we're in a multipolar world, but you never know. You have to run.
That's just because people have a very short attention span. It's faith requires longevity in thinking and belief, and unfortunately, everyone's got a short attention span. But the look, something's uninvestable like Treasuries or like China stocks until it's working, until there's performance and momentum. Then it's investable. I don't believe all these arguments that it's not investable. Of course it's investable. You just need momentum to kick in. And everyone follows a chart because nothing gets flows like a chart. I know that as a fund manager.
Yeah. Speaking of uninvestable, Michael, let's end with one where I think you see opportunity, but tell me it could, because things are changing from when we talk from time to time. Something that's been left for dead is small caps. And
Yeah.
you're also just launched, by the way, an ETF that's looking at deregulation, even though everyone's losing faith in the Trump administration getting anything done. So do you still see opportunity in those two places? And talk to me about why amidst what looks like a world that's kind of cratering around us.
You know that meme of like Charlie Day where he's like going crazy and he's like connecting all the things. It's like, it's all connected, right? Okay, so all this is connected. I've kept on saying small caps hold the key because I believe there's a massive disconnect between default risk perceptions there relative to credit spreads, which are normally tight. There's a mismatch in two asset classes. Small caps hold the key. Why? Because if it's a true bull market, a rising tide should lift all boats. You shouldn't be in the environment that we've been in where that's not happening. It's like you have this massive bifurcation between large and small. Okay. Why is that? And now, why is that? Because there's zombie companies that, the fear is they may not survive higher for longer rates. Okay, well, here comes deregulation. Okay, deregulation should, at least theoretically, increase profit margins because now you're lowering a compliance cost and you're allowing for faster go-to-market strategies because you have less of a bottleneck from the government side of things approving. Okay, so small caps hold the key. Deregulation might be the key. Okay, that allows for those parts of the marketplace to thrive under higher for longer rates as a counter trend. But I'll take it even a step further. I can't really prove it, but I suspect that freer markets, which have more deregulation, less regulation, are probably in general, on average, more volatile than regulated markets, which means we're probably going to be in a cycle that has more risk on, risk off also. So I have this ETF that I launched with three other partners, the Free Markets ETF, which thankfully is getting some out of the gate pretty strong volume, that is designed to play the deregulation theme, okay? Because it's already a lot of things. There's been already a lot of deregulation, a lot of layoffs in government agencies, which is a form of deregulation just by the labor side. We built out a whole AI system that synthesizes all these regulatory measures, looks at companies, and with some human oversight, then we determine which companies should go into that portfolio. Primarily equities. We do have Bitcoin and gold in there.
Interesting.
Because those are great expressions of free markets anyway. And again, those are volatile assets, so it makes sense. But look, I think deregulation is going to cause a massive rotational shift, independent of FMKT, the free markets ETF, from large into everything else. And I think with that, you're going to see more pockets of volatility, which if you're tactical as a trader, you should love.
Right. Right. And that's the thing. I like ending these conversations on opportunity because there's an entire industry out there that's just set up to scare people, and you can feel paralyzed in this situation. So I wanted to have you both talk about the risks that I think don't get enough airtime, although you two are doing your best to make sure you highlight it for everybody.
Weston's a rock star. Come on.
Around the pan. Seriously. And in fact, I'm always sort of testing that because I've talked to both of you about it. And then I still email Weston like, are we paying enough attention to this? And he's like, no, we're not. So I appreciate both of you coming on, but I like ending with the idea that there's opportunity. Weston, you want to weigh in on?
I have a question. No, yeah, I have a question for Guyed Son. Congrats on the ETF.
Thank you.
I suggested a better ticker, but whatever. It's your ETF.
You don't want to get demonetized on YouTube. You don't want to get demonetized on YouTube.
Yeah. Two questions. One of them is, so like when you brought this up, when you unveiled it, I thought it was a brilliant theme, and then I thought that there has to be other ones that exist, but yours is the first to do that. So my question is, like, did you really beat everyone to the game, or has that been tried and there's some sort of roadblock and there's something, like whatever it may be, like because it's too policy oriented, because it's like they people pick the wrong, like whatever it is, and I know you have an AI sort of model in which to sort of,
because
or are you really the first out the gate? And then my second question is it basically like, so the upside is like, okay, so as the regulation gets, or deregulation, where like red tape gets cut in here and unlocks value, that's the upside. But if that doesn't happen, well, I mean, they've been like, there's really isn't downside because like they're already living in this over regulation as is anyway. And is that sort of the approach? Or well, I guess what would be the downside? Like further regulation? I think that markets would price that in, or already, right? So
Sure.
those
Yeah.
are my
So
two questions for you.
no, it's a good, and I appreciate you asked. So because you're right, it's like, well, I mean, Trump did deregulation in his first term, right? So why did somebody else do it then? Because the truth is, you didn't have AI to synthesize all this stuff, and he's obviously much more aggressive on the deregulation to 10 for 1 versus 2 for 1, right? For every proposed regulatory move. The other part of this is okay. So let's say you have because some people think it's political. I'd argue it's not political; it's profits. So even to the extent that you have a Democrat come in next time and then put regulations, aside from the fact that it's hard to do that also across the board, like once you take it away, it's hard to kind of put it back in to some extent. But even that's the case, there will still be relative winners and losers. Right now, one of the interesting things about the theme of deregulation is that the lowest weighted sector is tech. The highest weighted sector is energy. Right, and there's a lot of
That makes
interesting
sense,
dynamics, of course, and right alongside financial, of course, makes sense. So there's also this kind of other tailwind potentially, which I think, independent of deregulation and that ETF and the screening on the stock picking side, is interesting, which is maybe we're finally in an environment where value works again, and that explains also why international stocks are doing what they're doing. I actually believe there's a lot of big tectonic, stylistic asset allocation shifts taking place anyway, right? And deregulation benefits in small cap stocks.
Is it deregulation kind of almost like a headline, and then you get like a PE, like a premium like lift off of it, or is it like a fundamental? Right, because that could be reversed by another administration, and then so I'm assuming you would cut that whole thing once realized, so you're basically unlocking premium.
Right, and so an example of that is Uranium Energy Corp. Right, so on the executive order that Trump did, as far as we need to get more uranium, which we only produce 1% of the world's uranium. Uranium Energy Corp is the largest U.S. uranium producer, and if you look at uranium stocks, they've been on fire, maybe pun intended. But that's why is that? Because the bet is now that there's going to be more activity going on, right? And who knows? Maybe this war with Israel and Iran may even accelerate the sort of spotlight on uranium, right? And even though we have plenty of oil in the U.S., it's just another excuse to try and put more there. So like that's an example. So there should be, if the market's a forward-looking mechanism, it should say, okay, these companies, these industries, now that there's this deregulation dynamic tailwind, it's the delta. It's the differential of how they operated before, which is versus how they can operate going forward.
Yeah, and identifying them early,
right,
with your tools. Great stuff.
Yeah, not to like give Michael's not paying me to say this, by the way, but the reason I think it's brilliant is because if you want to just look at broadly, if like a Trump administration sort of trade or whatever, if you will, if like tariffs, if that like ends up like blowing up your portfolio, and or like the big beautiful bill or all that kind of thing, then he has to double triple down on on the deregulation thing, right? So it kind of is like so like it's almost a hedge against like if those other things don't go right, then he's got to do that cutting,
because he's at least delivering on something.
He's got nothing else, and it's funny because I was a real quick one,
uncorrelated uncorrelated sort of returns. Yeah.
And I'll give you a real quick, which I think is a good place to wrap up. I did a poll on X again at Lead Ladder Report, and I said, if you're a small business owner, which of these three matters more to you? Taxes, tariffs, deregulation.
Oh, deregulation.
The winner was deregulation.
Yeah. Every day, all day when it's small business.
So and to Weston's point, tariffs have not helped Trump's optics. The big beautiful bill with Musk and that TIF obviously didn't help the optics. The dude's only got one play left. Deregulation's it.
Trump has always said that himself. Like I know you have a big following, but I think Donald Trump might have a bigger one. And he would always say like I talk to business leaders and like in the first administration, I would say like, what did I do best on? And people would, like, was it taxes? And business leaders and business people and small business would always say, regulation cuts. So that's what he's saying. That's his mentality. That might be like kind of like a.
Let's watch over the summer because he'll start tweeting about it a lot too as that pivot happens. So listen, I could talk to you guys all day. We gotta wrap it because I know you have to go. It's a busy. We're just getting started here in the U.S. It's a busy day, but appreciate both of you so much for, I think, helping fill in a lot of gaps on these really complicated markets, especially the view, Weston, from Asia, which is so critical. So thanks to both of you so much. I appreciate you both.
Thank you.
Few.
Yes. Everybody who knows and follows on X. And we will put links, of course, to everything in the description so you can find more on the great work that both Weston and Michael are doing on this. Thanks, everybody. As always, take care and good luck out there.